Hello everyone, welcome to my YouTube channel. We are discussing about the accounting for managerial decision. The first unit is accounting and overview. Introduction to accounting. In early days, the business organizations and transactions were small and easy manageable by the owners of the business themselves. The businessman used to remember the transactions by memorizing them. In those days, accounting developed as a result of the needs of the business to keep relationship with the outsiders, listing of their assets and liabilities. The business concern has constantly entered into transactions with outsiders. In addition to the transactions with outsiders, there are also events requiring monetary record. It is not possible for a human being to keep in memory all the transactions. Therefore, it is necessary to record all these transactions properly to get required financial information. Then, definition of accounting. According to the American Institute of Certified Public Accountants, AICPA had defined accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. Another definition has given by the American Accounting Association. Accounting as the process of identifying, measuring, and communicating economic information to permit informed judgments and decision by users of information. Then what are the functions of accounting? Here are the functions. First one is identifying financial transaction. And second one is recording of financial transactions. Classifying the transactions, summarizing the transactions, interpreting of results, communication owner or management, make a decision, interested parties and make a decision. Recording of financial transaction. It means the accounting process begins with the basic function of recording all the transactions in the book of original entry. This book is called journal. The journal is a daily record of business transactions. All business transactions of financial character are recorded in the journal in a chronological order. Like a date wise with the help of various vouchers such as cash memos, cash receipts, invoices, etc. Then second one is classifying the transactions. The journal is a just chronological record of all business transactions and it does not provide all information regarding a particular item at one place. To overcome this difficulty, we maintain another book called as ledger. The objective of classifying the transaction in this manner is to ascertain the combined effect of all transactions of a given period in respect of each account. For this purpose, all accounts are balanced periodically. Then third function is the summarizing the transactions. The third step is presenting the classified data in a manner which is understandable and useful to the internal as well as external end users of accounting information. This can be done through the preparation of a end year summary known as final accounts. Before proceeding to final accounts, one has to prepare a statement called a trial balance in order to check the arithmetical accuracy of the books of accounts. If the trial balance tallies more or less, it means that the transactions have been accurately recorded and posted into the ledgers. Then, with the help of the trial balance and some additional information, final accounts are prepared. The trading and profit and loss account gives information about the profit or loss made during the year, and the balance sheet shows the position of assets and liabilities of the business at a particular time. Then last one function is interpreting the results. The final stage of accounting is analyzing and interpreting the results shown by the final accounts. The recorded financial data is analyzed and interpreted in a manner that the end users can make a meaningful judgments about the financial position and profitability of the business operations. This involves computation of various accounting ratios to assess the liquidity, solvency, and profitability of the business. The balance on various accounts appearing in the balance sheet will then be transferred to the new books of accounts for the next year. Thereafter, the process of recording transactions for the next year start again. Then let us know about the objectives of the accounting. First one is to maintain systematic records. Accounting keeps systematic records of all financial transactions like a purchase and sale of goods, cash receipts and cash payments, etc. It is also used for recording all assets and liabilities of the business. Accounting, it is impossible to a human being to keep in memory all business transactions. Second one is to ascertain the net profit and net loss of the business. By keeping a proper record of revenues and expenses of a business for a particular period, accounting helps in ascertaining the profit or loss of the business through preparation of profit and loss account. Profit and loss account helps the interested parties in assessing the profit or loss made by the business during a particular period. It also helps the management to take remedial action in a case the business has not proved remunerative or profitable. A proper record of all incomes and expenses helps in preparing a profit and loss account and in ascertaining net operating results of a business during a particular period. And third one is to ascertain the financial position of the business. The businessman is also interested to know the financial business position of his business apart from operating results of the business during a particular period. In other words, he wants to know how much he owns and how much owes to others. He would also like to know what happened to his capital, whether it has increased or decreased or remained constant. A systematic record of assets and liabilities facilitates the preparation of a position statement called balance sheet, which provides the necessary information to the above questions. Balance sheet serves as a barometer for ascertaining the financial solvency of the business. Next one is to provide the accounting information to the interested parties. Apart from owners, there are various parties who are interested in accounting information. These are bankers, creditors, tax authorities, prospectives, prospective investors, etc. They need such information to assess the profitability and the financial soundness of the business. The accounting information is communicated to them in the form of an annual report. Next one is to make decision making. Accounting helps management to take a accurate decision. And last one is to fulfill the legal requirement. Accounting helps to fulfill the legal requirements of the business. Then who are interested in the accounting information? Many people are interested in examining the financial information provided in the financial statement beside owner or management of the concern. These financial statements helps them to know the following: to study the present financial position of the business, to compare its present performance with that of past years, and to compare its performance with similar enterprise. Here are the interested parties. First one is shareholders. Shareholders are the real owners of the company because they contribute the required capital and take the risk of business. Obviously, they are interested to know the result of operations and the financial position of the company. The shareholders are also interested to use the accounting information to evaluate the performance of the managers because in company type of a organization, management of business is vested in the hands of paid managers. Second one is prospective investors. The persons who are interested in buying shares of a company or who want to advance money to the company would like to know how safe and rewarding the investments already made or proposed investments would be. Accounting information serves their purpose. Next one is lenders. Initially, the required funds of the business are provided by the owners. When business is going on, it requires more funds. These additional funds are usually provided by banks and other money lenders. Before lending money, they would like to know about the solvency of the enterprise so as to satisfy themselves that their money will be safe and repayments will be made on time. Creditors. The creditors are those who supply goods and services on credit. These creditors, like other money lenders, are also interested to know the credit worthiness of the business. The accounting information greatly helps them in assessing the ability of the enterprise to what extent credit can be granted. Managers. Accounting information is very much useful to managers. It helps them to plan, control, and evaluate all business activities. They also need such information for making various decisions relating to the business. Government. The government may be interested in accounting information of a business on account of taxation, labor, and corporate laws. The financial statements are of great importance for assessing the tax liability of the enterprise, formulating labor laws, and corporate laws. Then, employees. The employees of the enterprise are also interested in knowing the state of affairs of the organization in which they are working, so as to know how safe their interests are in the organization. The knowledge of accounting information helps them in conducting negotiations with the management. Then researchers. The accounting information is of immense value to the researchers undertaking research in accounting theory and practices. The last one is citizen. An ordinary citizen as a voter and taxpayer may be interested to know the accounting information to measure the performance of government company or a public utility concern like banks, gas, transport, electricity, companies, etc. Then branches of accounting. First one is financial accounting. Financial accounting may be defined as the art of recording, classifying, and summarizing in a significant manner in terms of money transactions and events which are in a part at least of a financial character and interpreting the results thereof. And then functions of financial accounting: recording of information, managerial decision making, interpreting financial information, communicating results. Limitations of financial accounting. First one is historic nature. Financial accounting is the record of all those transactions which have taken place in the business during a particular period. As management decisions relates to future course of action, they are made on the basis of estimates and projections. A financial accounting provides information about the past data and not about the future. It does not suggest the measures about what should be done to improve efficiency of the business. Past data are needed for making a future decision, but that does not alone sufficient. Second one is it records only actual cost. Financial accounting has always been concerned with regard with figures, treating them as single, simple and silent items because it records only actual cost figures. The price of goods and assets changes frequently. The current prices may be different from recorded cost. Financial accounts do not record these price fluctuations. Therefore, the recorded information may not give correct information. Next one is it provides quantitative information. Financial accounting considers only those factors which are quantitatively expressed. Anything which cannot be measured quantitatively will not constitute a part of financial accounting. Today, business decisions are influenced by a number of social considerations. Government policies have a direct bearing on the working of business. Therefore, in addition to social consideration, the management has also to take into account the impact of government policies on the business, but these factors cannot be measured quantitatively, so their impact will not reflect in the financial statement. Next one is it provides information about the whole concern. Financial accounting provides information about the concern as a whole. It discloses only net results of the collective activities of a business. Detailed information regarding product wise, process wise, department wise, etc. is not recorded in financial accounts. Thus, product wise or job wise cost of production cannot be determined. It is essential to record the transactions as activity wise for cost determination and cost control purpose. Then difficulty in price fixation. The cost of the product can be obtained only when all expenses have been incurred. It is not possible to determine the prices in advance. Price fixation requires detailed information about variable and fixed cost, direct and indirect cost. Financial accounting cannot supply such information and therefore it is difficult to quote the prices during the periods of inflation or deflation in trade. Then appraisal of policies is not possible. Financial accounting do not provide data for evaluation of business policies and plans. There is no technique for comparing actual performance with the budgeted targets. Financial accounting do not provide any measure to judge the efficiency of the business. The only criteria for determining efficiency is the profit at the end of financial period. The next one is it is not helpful in decision making. Financial accounting do not help the management in taking strategic decision because they do not provide adequate information to compare the probable effect of alternative courses of action such as the replacement of labor by machinery, introduction of new product line, expansion of capacity, etc. Next one is lack of uniformity in accounting principles. Accounting policies differ on the use of accounting principles. There is lack of unanimity on the use of accounting principles and procedures. The financial statements prepared by two different persons of the same concern gives different results due to varying personal judgments in applying in a particular convention. The use of different accounting methods reduces the usefulness and reliability of financial accounting. Then next one is it is not possible to control cost. The cost figures are known only at the end of financial period. When the cost has already been incurred, then nothing can be done to control the cost. A constant review of actual cost from time to time is required for cost control, and this is not possible in financial accounting. The next one is possibility of manipulation of accounts. The over and undervaluation of inventory may affect the profit figures. The profit may be shown more or less to get more information, to pay more dividend, or to raise the share prices, or to save taxes, or not to pay bonus to workers, etc. The possibility of manipulating financial accounts reduces their reliability. Then last one is technological revolution. With the advancement in science and technology, very minute and detailed breakup of all types of data relating to the various parts of a business unit have become a must for the management of its day-to-day functioning. It is clear that financial accounting with its simple structure is not in a position to cater the needs of the management because it supplies only elementary information. Second one is cost accounting. Cost accounting is the process of accounting for costs. It includes the accounting procedures relating to recording of all income and expenditures and the preparation of periodical statements and report with the object of ascertaining and controlling cost. Cost accounting may be defined as the application of costing and costing principles, methods, and technical to the science, art, and practice of cost control and ascertainment of profitability. It includes presentation of information derived therefrom for the purpose of managerial decision making. The third branch of accounting is management accounting. Management accounting is the process of identification, measurement, accumulation, analysis, preparation, interpretation, and accumulation of financial information used by management to plan, evaluate, and control within an organization and to assure appropriate use of and accountability for its resources. Then functions of management accountant. First one is planning and controlling. Management accountant establishes, coordinates, and maintains an integrated plan for the control of operations. Such a plan would provide to the extent required in the business cost standards, profit planning, programs for capital investing and for financing, sales forecast, and the expense budgets together with necessary procedures to effectuate the plan. Second one is reporting and interpreting. Management accountant measures the performance against given plans and standards. The result of the operations are interpreted to all levels of management and to the owners of the business. This also includes installation of accounting and costing system and recording of actual performance to find out deviation if any. Next one is evaluation of policies and programs. Management accountant is responsible to evaluate various policies and programs. The effectiveness of policies, programs, and organization structure to attain the objectives of the organization to a large extent depends upon the caliber of the management accountant. Next one is tax administration. It is also the function of management accountant to report the government as required under different laws in force and to establish and administer tax policies and procedures. He has also to supervise and coordinate preparation of reports to government agencies. Protection of assets. The management accountant has to assure physical protection for the assets of the business through adequate internal control and proper insurance coverage. Next one is appraisal of external effects. Management accountant has to assess continuously the effect of various economic and social forces and government policies and interpret their effect upon the business towards the attainment of common goals. Then let us know about the accounting concepts. Accounting is the language of business. Accounting is the language of business. Business firms communicate their affairs and financial position to the outsiders through accounting in the form of financial statement. The first concept is business entity concept. According to this concept, business is treated as a separate entity from its owner. All transactions of the business are recorded in the books of the firm. Business transactions and business property are different from personal and transactions and personal property. The business entity concept is applicable to all form of business organization. This distinction can be easily maintained in the case of a limited company because the company has a separate legal entity of its own. But such distinction becomes difficult in case of a sole proprietorship or partnership because in the eyes of law, sole proprietor or partners are not considered separate entities. They are personally liable for all business transactions, but for accounting purpose, they are treated as a separate entities. Then second one is money measurement concept. Money measurement concept is that only those transactions and events which are recorded in the books of accounts which can be expressed in terms of money such as purchases, sales, salaries, etc. Usually, business deals in a variety of items having different physical units such as kilograms, quintal, tons, meters, liters, etc. If the sales and purchases of different items are recorded in the physical terms, it will pose problems. But if these are recorded in a common denomination, their total become homogeneous and meaningful. Therefore, we need a common unit of measurement. Money does this function. It is adopted a common measuring unit for the purpose of accounting. All recording, therefore, is done in terms of standard currency of the country where business is set up. For example, in India, it is done in terms of rupee. In USA, it is done in terms of US dollars, and so on. And this third concept is objective evidence concept. The term objectivity refers to being free from bias or free from subjectivity. Accounting measurements are to be unbiased and verifiable independently. For this purpose, all accounting transactions should be evidenced and supported by documents such as invoices, receipts, cash memos, etc. These supporting documents form the basis for making entries in the books of accounts and for their verification by auditors. As per the items like depreciation and the provision for doubtful debts, where no documentary evidence is available, the policy statements made by the management are treated as the necessary evidence. Next one is historical record concept. Recording the transaction in the books of accounts will be done only after identifying the transactions and measuring them in terms of money. According to the historic record concept, we record only those transactions which have actually taken place in the business during a particular period of time, and not those transactions which may take place in future. Next one is cost concept. The price paid at the time of purchase is called cost. And the concept, fixed assets are recorded in the books of accounts at the price at which they are acquired. This cost is basis for all subsequent accounting for the asset. For example, when an asset is acquired for rupees 1 lakh, it is recorded in the books of account at rupees 1 lakh. Even though the market value may be different later, but the asset is shown in the books at cost price. Next concept is dual aspect concept. This is a basic concept of accounting. According to this concept, every business transaction has a twofold effect. In a commercial context, it is a famous dictum that every receiver is also a giver and every giver is also a receiver. For example, if you purchase a machine for rupees 8,000, you receive machine on the one hand and give rupees 8,000 on the other. Thus, this transaction has a twofold effect, that is increase in one asset and decrease in another asset. Similarly, if you buy goods worth rupees 500 on credit, it will increase an asset on the one hand and increase a liability on the other. Thus, every business transaction involves two aspects. First one is the receiving aspect and second one is the giving aspect. This principle is the core of double entry bookkeeping, and if this is strictly followed, it is called double entry system of bookkeeping. The next concept is going concern concept. According to this concept, it is assumed that every business would continue for a long period. Keeping this in view, the investors lend money and the creditors supply goods and services to the concern. For all practical purpose, the business is normally treated as a going concern unless there is a strong evidence to the contrary. For example, a firm purchased a delivery van for rupees 1 lakh and its expected life is 10 years. The accountant has to spread the cost of the van for 10 years and charges rupees 10,000, being 1/10 of its cost to the profit and loss account every year in the form of depreciation and show the balance in the balance sheet as an asset. While preparing final accounts, a record will also be made for outstanding expenses and prepaid expenses on the assumption that the business will continue for an indefinite period and the assets will be used for its expected life. Next one is accounting period concept. Going concern concept assumes that life of the business is indefinite and the preparation of income and positional statements after a long period would not helpful in taking appropriate steps at the right time. It is necessary to prepare the financial statements periodically to find out the profit or loss and financial position of the business. Accounting period may be a calendar year, that is from 1st April 2022 to 31st March 2023. The next concept is matching concept. Matching concept is based on the accounting period concept. The matching concept is also called matching of costs against the revenue concept to ascertain the profits made by business during a particular period. The expenses incurred in an accounting year should be matched with the revenue on during that year. The next one is conservation concept. This concept is also known as a prudent concept. Conservatism refers to the policy of choosing the procedure that leads to under, understatement of assets or revenues and overstatement of liabilities or costs. Then consistency concept. The principle of consistency means that the same accounting principle should be used for preparing financial statement for different periods. It means that there should not be a change in accounting methods from year to year. Comparisons are possible only when a consistent policy of accounting is followed. Full disclosure concept. This concept states that the financial statements are to be prepared honestly and all significant information should be incorporated therein because these statements are the basic means of communicating financial information to all interested parties. Last one is materiality concept. This concept is closely related to the full disclosure concept. Full disclosure does not mean that everything should be disclosed. It only means that the relevant and material information must be disclosed. American Accounting Association defines the term materiality as an item should be regarded as material if there is a reason to believe that knowledge of it would influence decisions of informed investors. For example, if an amount of rupees 1,45,923.28 is shown as rupees 1,45,923 or rupees 1,45,900, it does not make much difference for assessment of the performance of the enterprise. If you have any questions regarding the concept, then you can ask in the comment section. Thank you for watching. Don't forget to like, share, comment and subscribe to my YouTube channel.